Hello everyone, welcome to my newest video. In this video, I will talk about money creation and how money is created and enters the money supply. And I will do so by debunking fractional reserve banking. There's a myth going around that banks cause inflation by creating money out of thin air. That is because of fractional reserve banking. And it's really frustrating finding a serious source because pretty much every single YouTube video or article focuses on the later part of how money enters the economy while completely ignoring the actual source of the expansion of the money supply in the first place. Alright, let me explain the argument. But before I start, why don't you subscribe and share and click the bell button to not miss out on any new video that I put out. And if you want to support me, the link for my Patreon blog is in the bio. All right, let's get started. So, fractional reserve banking is a regulatory measure that mandates banks to keep a certain percentage of total deposits as reserves and invest the remaining to maintain a banking system's functioning. In other words, let's say you deposit $100 and the bank loans out $1,000 to you while keeping a fraction of that deposited money as their reserve. They can do that because they are allowed to have a certain amount of liabilities. This process can be repeated indefinitely, and money is magically created and enters the economy through credit. This is why bank runs are so bad, because if everyone decided to pull out their money all at once, banks did not keep any of the deposited money as their capital. So the money doesn't actually exist. It was simply created as a new liability entry on the bank's balance sheet. Makes sense, right? That's basically the argument. There's just one factor we're missing here, and that is that most assets the bank owns are in the form of loans that they themselves back up by credit. It is true, the money you deposit doesn't increase the bank's capital. They don't need your money to make new loans. And it's also true that banks don't let out their reserves. They don't need your money to create credit because private banks use repo markets to swap cash around to increase or decrease their reserves/capital to back up the allowed amount of liabilities. So most of the bank's assets don't need to exist in the form of capital, but does exist in the form of loans that they back up with their own credit. They can do so through repurchase agreements or repos, which is a form of a short-term borrowing for central banks in government securities or bonds. In the case of a repo, a central bank sells government securities to commercial banks, usually on an overnight basis, and buys them back the following day at a slightly higher price. That small difference in price is the implicit overnight interest rate. Well, that's at least a theory, but realistically, there's nothing to stop the overnight interest rate to be near zero. So repos are used to raise short-term capital. They are also a tool for central banks for their open market operations. Repos are how banks maintain their reserves, and if a commercial bank needs cash and no other bank is there to lend it, the commercial bank can just borrow money from the central bank. So the money that the commercial bank supposedly created through credit is in fact backed up by credit to the central bank, which creates money out of thin air. This whole money creation chain starts with the treasury selling government securities to the central bank. The central bank buys those securities or bonds with money that they create at super low interest rates. This way, the government now has money that they can spend on whatever welfare program or other forms of free money they promised to give their citizen to get reelected. That newly created money can enter the economy directly through stimulus checks or certain funded programs or through the repo markets. That is what increases the money supply and causes inflation. Not the commercial bank giving you a loan that happens at the end of the chain of money creation. So if repos are used to flood the economy with new money and give commercial banks fresh cash, then reverse repos are supposed to do the opposite. If inflation is running too hot and the central bank needs to cool down inflation, they can slow down the demand by doing reverse repos. I want to show you a certain chart. Here's a chart for everyone arguing that banks create most of the money and only a tiny amount is created by the Fed. Look at this. This is all the money that was printed right after the 2020 COVID crash. The inflation we are facing today, more than 2 years later, has nothing to do with it. Well, banks could have created all this money all this time, but the inflation only really happened right after 2020? Strange. Here's another chart. Here are the numbers of reverse repos just about a year after the massive amount of money that entered the money supply through the Fed, the American Central Bank, by creating all this money out of thin air. Also, here's a small detail. Money saved in the savings accounts has been removed from the M2 money supply. It has been discontinued right after the release of these numbers to hide where inflation is actually coming from. I talked about this in a video from me from last year. The link to that video is attached below. So, do commercial banks create money? Not really. If you don't believe me, well, here's an article right from the Bundesbank themselves. So, it says here, quote, "Despite its ability to create money, a bank still has to fund the loans it has created since it needs central bank reserves for the cashless settlement of payments when sight deposits created by lending are transferred to other banks. These are balances which only the central bank can create." Again, can commercial banks create money? Sort of. Can they increase the money supply, meaning actually create money? No. Only the central bank can do that. So you might ask yourself, what's the big deal? Why is this so important to you? Why are you making a whole video about this? Well, I'll tell you, because it's there to fool you. It's there to fool you and blame everyone else but the government for the problem that they created. And if you say, oh, well, I thought the central bank is a private entity, think again. Which private entity gives out loans and prints money on demand for 0% interest? Which private entity does that? That doesn't make any sense. In short, the Federal Reserve creating money is basically the government printing money with extra steps to make things more complicated and confuse you into blaming private banks or corporations or anyone else but the government for causing all this inflation. That's also the reason no one explains the source of the expansion of the money supply to you. And almost all sources, including government websites, talk about the myth of money creation through fractional reserve banking. So, it's a central bank or the Federal Reserve creating money and causing inflation, not commercial banks.